Welcome to everyone that is joining us for this evening's webinar. And those of you that are going to fail to join the Zoom meeting, please go onto our YouTube. This is being streamed there simultaneously. Today, I'm excited to be here to discuss a very important topic, that of global estate planning. But before we get that, as we await other people to join, I want to talk about some few house rules. Number one, we are going to be using the chat section for you to ask questions. So please put your questions as the speakers are speaking, as well as if you think of anything, even if it has not yet been covered by the speakers. During the Q&A, which will be at the end of the presentation, I will allow one or two people to ask their question verbally. So please be on the lookout for that. Today's webinar will qualify for one ethical CEU, but please, you need to be here throughout the whole presentation, as you know. Thirdly, in terms of your certificates, these are going to be uploaded on the HPCSA website by SADA, but they will also be available on the profile, your profile on the system. But in terms of the profile, I do want to warn you that we are moving into a new CRM system tomorrow. So please give it about 10 days before you go in and check, otherwise you'll be frustrated. Other than that, ask as many questions as you want. We do have a limitation of time, but I believe we'll give you enough time to ask those questions. So maybe let me start by welcoming everyone again and talking about, you know, I like to make a joke at the beginning. So there was this farmer in a village. This village was called Pampoensspruit, somewhere in South Africa. This farmer owned a geese. He owned geese, so, and he had a goose that was giving him a golden egg, and he was collecting a golden egg every single day from this goose. And he was so excited. It was a very shiny, beautiful egg. And then one day he decided, you know what? Why should I be collecting one golden egg from this goose? And he decided to take the goose, open it up, so he can collect all the eggs, the golden eggs, in one go. Unfortunately, he was disappointed. When he opened the goose, there was absolutely nothing. Now, he didn't get all the golden eggs that he thought he was going to get, and the goose is dead. So which means he's not going to get any other golden eggs going forward. The moral of the story, ladies and gentlemen, is that when we do investment or we make decisions of investment, we must always think about the long-term goal. We must not be greedy to want something that will happen immediately. Also, there are processes that we have to follow. You have to wait. You have to make sure that your paperwork is right. All of those things. And you have to make smart decisions. Because if this guy did not kill the goose, I can tell you he would have made more golden eggs every single day. And those golden eggs is what he could have actually transferred to his children. And his children would have transferred some of those to his other children. So, ladies and gentlemen, today, dealing with global estate planning, to effectively preserve and transfer wealth from one generation to the next, those golden eggs, comprehensive global estate planning is essential. And that's why the two gentlemen that I'm going to introduce to you later are here. So to what extent are trusts, both local and offshore, still relevant in estate planning? Have you considered the offshore legalities and processes of offshore planning? That is a question that the two gentlemen, Stanley Brown and Reginald Laboskachny, are going to talk to you about. Let me give you a little bit of background of the two gentlemen that are coming from Sanlam Private Wealth. Stanley Brown is currently employed at Sanlam Private Wealth and is the head of fiduciary and tax, providing tax advice to ultra-high net worth individuals, which I believe all of you that are attending today are. He completed his master's in international tax at UCT, postgraduate in taxation law at UNISA, business development studies at USB, and a Bachelor of Commerce degree at UWC. We used to call it Bush during our time, and various other qualifications that he's got. Basically, he's a very clever man. He's a registered tax practitioner, MTPSA, at the South African Institute of Tax Practitioners, a registered associate general accountant, AGASA, with the South African Institute of Chartered Accountants, SAICA, and a registered tax practitioner with the South African Revenue Services. Reginald Labuskaghni is the head of product and strategy for Sanlam Private Wealth. He has 20 years of experience in the financial services industry, largely focused on strategically repositioning existing business as well as growing new ones. He holds a BSc honors and a CFA charter holder. He's got other qualifications. If I were to read his full bio, again, we're going to be here the whole day. Ladies and gentlemen, without further ado, I want to hand over now to Reginald. Reginald.
Casey, thank you. Firstly, I think on behalf of Sanlam Private Wealth, thanks to you and the association for having us. I think it's important for us to have these engagements and understand the concerns facing your members. So yeah, we look forward to this engagement, and hopefully we'll find some common ground for further engagement into the future.
Absolutely,
so
absolutely.
I thought I know everyone hates death by PowerPoint, but I thought it's probably important for us to just get through a couple of slides just to provide some context for the conversation today. So I put a couple of slides together, just give some background on Sanlam Private Wealth, because I think firstly, everyone knows Sanlam. It's a big brand in South Africa. We sit within the bigger mother brand of Sanlam, but we focus majority of our time on high net worth individuals. So we know Sanlam Private Wealth. So as I said, probably the lesser known company within Sanlam. But maybe just a bit of context of where Sanlam Private Wealth is and what we do for clients and why it's important, just to create this context. So firstly, we currently got a footprint across 3 jurisdictions. So South Africa, Mauritius, and UK. We're busy looking. We've just set up offices in Guernsey as well. So that's the last part that needs to come into this map. And we're looking to expand further into an offshore jurisdiction, which most people know in Guernsey. So we've got about 400 staff throughout all these jurisdictions. And if you look at our total asset base, because at the end of the day, we look after clients' assets, our duty is to look after clients' hard-earned money and make sure that whatever their goals are, that we help them achieve those goals. Clients have entrusted us with about 188 billion of assets that we manage. So we're currently the second largest private client business in South Africa, and we've had some good growth in the business as a result of the good relationships we have with our clients. Just to give an idea, on the South African side, where we manage assets, so we've got 3 pools of money we look after for clients. Some where clients give us full control over the assets. They say, listen, I've got a certain goal. You need to manage my money within certain risk parameters, and we try and achieve that goal for them over time. That is what we call a full discretionary management account. So, we've got full control within certain parameters with the client. Then we've got the second part where clients, and we often find in the medical profession, people like to be in control of their investments. They like to understand what's going on with the shares or the underlying assets that they hold. So there we go. We basically have a co-pilot model where we sit with the individuals. We discuss whether we think a local share or offshore share or some type of investment is a good or bad idea, and then we implement on the back of their inclusion. And then we've got some clients that just send us instructions, just buy and sell stuff for them. So we've got 3 big pockets or buckets of money. This is just talking where we've got full discretion. So you can see we've had some healthy growth in the business over the last kind of 6-7 years. That last one, if you go to 2022, end of last year, we're sitting at about 110 billion in assets under full management. But the interesting thing in our business, and that's what we're talking a lot about tonight, is we've seen a massive shift in our clients' attitude. And it's not just us making a decision on behalf of our clients. We have a lot of clients coming to us and saying, I want to be measured in dollars. I want to be measured in hard currency because I'm thinking 2 or 3 generations out. So I want my money in hard currency, and you need to manage it in hard currency. And that shift we've seen in our business, if you're talking about a pot of 110 billion, we've shifted from 26% local only versus, offshore only versus 74 local to almost, we're over 50-50 local offshore now. We've almost got more money offshore than local we manage for clients. And then that's been a big shift. And part of it is South Africa is a small economy. There's a lot more opportunities outside. But there's also, unfortunately, with the situation in South Africa, there's always confidence in the future. So people want to hedge their bets into the future, and that we've seen quite a bit. So maybe just why clients choose us, I think it's always quite important. So at the heart of it, we're a private client portfolio management business. We manage money for individual clients in their personal capacity. But the way we do this is we've basically got a central investment team that sits and they do all the research and look at the world. They're trying to understand what's going on in global markets, local markets. But at the end of the day, every single one of our clients faces a highly qualified portfolio manager. So we've got about 70 of these portfolio managers throughout the country. We've got 8 offices throughout the country. And clients have access to a well-qualified portfolio manager that can tell them and advise them on the stocks and actually manage the stocks and the assets within their portfolio. So we really pride ourselves on the quality of the individuals that deal with our clients. And the big difference between a private client investment or a portfolio versus just a standard unit trust fund or a collective fund that people invest in, you've got access to that investment professional making a decision in your portfolio. And I think that's where we see a massive change in the difference between us and a standard investment out there. Because if, as an example, we decide to buy Sasol or Apple or whatever the story might be, or a new private equity fund that we bring into your portfolio, you speak to us and you understand why that is coming in. The same as we can cater your portfolio and amend it, that as an example, if you have got, for ethical reasons, health reasons, personal reasons, you've got certain exclusions you want in your portfolio, like you don't want any tobacco stocks or any of the sin stocks, we can exclude that of the portfolio. You don't just go into a big fund that's got everything in it. So that's quite a big part of it. Our fees are very much based on the assets that the clients have with us. We've got a sliding scale. The larger the assets, the lower the fees go. So we think that is typically a fair way of treating our clients. And as I said earlier, I'm going to talk a bit about the investment performance before I get to the other stuff, because at the end of the day, we say we're a portfolio management company, but have we delivered the results? And I'll show some slides, just 1 or 2 slides on that just now. Just a broad range of stuff we do. As I said, at the heart of it, we manage assets, and we have to do that well for clients. And so we do that. We've got a range of local portfolios, whether it's listed shares only. We've got multi-asset portfolios, so everything from bonds, cash, property, that's in a mixed portfolio, so it's got different risk profiles. I'll show you just a high level what that looks like. Worldwide, global portfolios, etc. But once we sit and we understand the client's needs and we know firstly what the objective is to manage it, there's a lot more that comes with that. And part of it's what we're going to be talking to Stanley about just now, because we have to understand that client, especially if you start talking multi-generation or large assets, are you structured correctly? So you have to think about your global scenario. Have you got kids that's overseas? So all of that stuff we're going to talk about. I don't want to steal Stanley's thunder on that one. But that's a tax and fiduciary side that is a very important thing. And remember, the tax laws and everything changes on a continuous basis. So if you don't review these things, we've got so many clients that had something set up 5 or 10 years ago, and the laws have changed so much that they're sitting with so many penalties or issues now. To unwind that is quite difficult. So we spend a lot of our time, and the team spends a lot of their time unwinding stuff or just helping clients guide into a new structure or a different way of doing things in order to solve a lot of those things. We've still got the standard stockbroking, so clients that just want to, we say, always play in the stock market. They want to, they've got a good feeling of what they think is good and bad investments. They just want to tell us what to buy, even derivatives and the really racy stuff. We've got, that's a smaller part of our business, but we do that for our clients. And then the very interesting one is this equity-backed lending. And we've got quite a couple of medical staff or medical clients across the country where if someone's got a portfolio with us and it's not, you can't take pension assets, but a lot of your after-tax money is in discretionary money. So if that is in a portfolio with us and someone wants to buy a new piece of equipment for a practice as an example, we can actually lend against their portfolio. So if someone's got, as an example, 10 or 20 million rand investment with us, we can, depending on the quality of the nature of the underlying shares, so if you've got everything in a small single share, that's very different compared to a top 100 share portfolio as an example. But we can lend up to 50% against the value. So if you've got a 10 million portfolio, we can make a loan up to 5 million against that portfolio. You can use that money in the background however you feel fit. And it's almost like, it's basically like a loan against your assets. And you can pay as and when you want to pay. There's not a monthly repayment on the back of that. So we manage the risk of that loan with the client and just make sure that it stays within certain parameters. So that's just a high level. Hopefully that will spark some questions for the audience. As I said, we set up to manage individual clients' assets. I'm not going to take too much time on this. I think it's quite important. Most people want to understand risk and return. As you go, if you want to get a higher return over time, you need to take more risk. And that typically comes investing more in equity-like investments. So we've got a range of portfolio that goes from lower risk, where there's less risky assets in, more low-risk assets like cash or bonds. But the bonds are always low risk, but stuff that's got different characteristics to equities. And so we go up the risk spectrum with a range of different model portfolios that we run for clients. I'll explain how we populate these things, and the same with the range of offshore portfolios that we run for clients. Now, what's very important is how we go about constituting. This is where private client portfolio really becomes different, because we take all of those model portfolios that we construct for clients. We've got a very strong team in the background that sits, as I said, they look at the markets, they understand what's going on with the movements between local equities, bonds, cash, offshore, and they make a relative allocation to say, at the moment, we probably think offshore markets are either expensive or cheap relative to local markets, and we start driving the asset allocation within certain things. But I think very important is when we go select the underlying securities to populate, whether it's the share component or the bond component, we've got a range of tools that we can either go direct shares, we can buy funds for the client, and we can populate it according to the client's needs, depending on their circumstances. With our clients that are sitting with higher assets with us, they've got less liquidity, so they've got a lower requirement for income, or they can stand, I'd say, a more illiquid investment over time. We can even bring things like private equity, private credit into the investments where it's relevant for them. So that's where the private client portfolio will typically differ quite a bit from a standard fund. And as I said earlier, if you talk all these things, do we deliver for our clients? Just 2 or 3 slides and I'm done. And this is just an example of our general equity portfolio. So if you just talk general shares in South Africa, the blue line, this is going back to 2005. So it's a nice long track record, about 17 years. And if you look at that blue line, that's the performance of our clients' portfolio after tax. So the Sanlam Private Wealth performance. That next little brown line, and hopefully the colors come through on the screen, I assume they would. But that brown line is the actual JSE All Share. That's what everyone talks about. Sometimes you just need to beat the market. So we've done that quite nicely for our clients over time. But quite interesting, that darker line right at the bottom, that's what the average general equity fund has done in the market. So a lot of the funds are actually underperforming the market, and you can see the difference there. And then the same with our multi-asset portfolio, so our balanced portfolio. This is typically something that's got between 60 and 75% equity in it, and the rest in bonds, cash, again, offshore, local, a whole bunch of different things in here. But you can see that black line this time is the general balanced fund in South Africa, and how our private client portfolios have outperformed that. And the next one down is just the moderate balance. It's just lower amount of equity, and again, you can see the general outperformance there. So again, just in summary, before I hand over to Stanley, what we do is we sit with our clients, we understand their needs, we build portfolio around their requirements, but more important, so that's the foundation of what we do. We have to manage the assets well. But all the other stuff, we can manage the assets well. If you don't get your structuring right, you can lose a lot of money by having a liquidity event, whether it's at your passing or whatever might happen in the future when you pass it on to the next generation or your beneficiaries. You can really end up losing a lot of money if you don't structure your things correctly. So I think with that, I'm going to hand over to Stanley to just give a brief intro, and I think then we'll head over to questions.
Thank you, Reginald. Thank you, Casey, for the opportunity. Thank you for your listeners and viewers. So I'm the head of the Fiduciary and Tax Department, as you've noted before. And what we typically do is we look at the client's holistic affairs. So when we look at the client's holistic affairs, we look at all of the assets of the client. So the portfolio that the client holds with SPW or with any other investment house forms part of what we look at specifically for the client. But what is key is important is that we do understand that our clients, especially our high net worth and ultra high net worth clients, are global citizens. So it's these typical clients that hold assets not just only in South Africa anymore, but they actually hold assets abroad in other countries. So part of the global estate planning is to ensure that when we look at the client's planning, it's more than just drafting a will. We look at all of the aspects. We look at who is the client, understanding the client's needs and client's objectives, and how do we come to support the clients in order to structure their affairs accordingly, making the client aware of the possible taxes in other jurisdictions, the processes that we have to follow at date of death. So your global estate planning is to say, yes, a lot of people say, please, I don't want to pay any more taxes. No one of us wants to pay any more taxes. That's a given. But taxes will always change. But I normally tell the clients when we sit with them and we do global estate planning is, what is your objective? How do we ensure that the wealth that you have created over these years through your practice, through your hard work, through your investments, can actually move from one generation to a next generation? What's the proper type of planning? What's the proper type of vehicle. Is it a local trust? Is it an offshore trust? Is it a different type of investment that Sanlam Private Wealth must look at for you? But also we look as part of the global estate plan, because our clients is what I call global citizens, if I can use that as for lack of a better term, to say that if you've got assets located in the UK, we have to look at inheritance taxes at the UK and how will it affect you. If you've got assets in Ireland and we have to deal with those specific assets at your date of death, is your asset structured properly in terms of date of death, because the regimes and the laws of those jurisdictions are different. We look at countries where our clients might have assets like properties, etc., in France, in Italy, in Portugal, and these are like, for example, your civil law countries. And the question is, when you pass away, can one actually just use your SA will to deal with these assets? What's the processes? How does the laws work? So global estate planning is more than just drafting a will. It's actually taking and looking at the whole situation of the client. What is your objective? And then what we do is we bring everything together to align it with the objective of the client. And that's key and that's important, because when that person passes away one day, that person wants to leave knowing that everything else has been taken care of for my family. So there is no unnecessary tax leakages. There is a reduction perhaps in estate duty. There is no unnecessary taxes that I have to pay offshore because they have given me an alternative. So the effect is the same, but where we then decide to invest with the help of Reggie and the investment team will perhaps be different. So we look at all of these affairs, and so we are a whole team of people, fiduciary and tax specialists that focus on local advice for clients, offshore advice for clients. We do the world drafting local and offshore for clients. We handle offshore estates for clients. We are corporate trustees on local trusts, etc. But we look at all of these assets. And as we go through this evening, we will discuss a few of the pitfalls that we see based on our experience with clients. And hopefully that will assist the clients and enlighten the clients to say, let's re-look at our affairs, let's look at what we've got, and let's make sure that everything is structured properly so that the fiduciary and tax team at Sanlam Private Wealth can step in and assist us in whatever we need assistance with.
Thank you so much. Thank you so much, Stanley. Thank you so much, Reginald. I'm hoping that members out there, you have started sending your questions so that the two gentlemen may be able to give you the information and the answers that you require. So, to the both of you, the audience that we have today, they spend their time in a dental surgery. They sell their time. If they're not there, they're not able to employ their skills to actually help the communities that they help. And because of that, if it comes to things like investment, they will always want to be comfortable that the vehicle or the house that they are using, the likes of Sanlam, is actually a vehicle that will take care of all the necessary decisions so that they can concentrate on their job as a dentist, for instance. So maybe the first question that I want to pose to you, and if you don't have the details, you can just give me an overview. In terms of can you talk about the experience of your team? How big is your team? If you are my consultant, for instance, or my key person, and you pass away, how easy is this to change over to another consultant, and that consultant will give me more or less similar advice that you would have given me? Can you talk about the depth and breadth of your management?
Yeah, absolutely.
And maybe also touch on the churn percentage if you have that in mind. If not, I understand.
No, I mean, I could definitely talk to that, and Stanley could probably from his side as well. So
Yeah.
I think the first thing, as I said, we've got, the people that are really sitting in front of clients and dealing with clients. There's
Yes.
70 of these clients, client-facing portfolio managers throughout the country.
Okay.
We are constantly looking to expand this as the business grows. But I think you ask some important questions is, what if something happens to one of these portfolio managers, somebody looking after the clients?
That's
So
correct.
we do have in each branch pretty much a team effect, because I mean, ultimately the client buys into what we do as a business, and we set the rules and the guidance as a business for these portfolio managers to follow at the end of the day. So for another portfolio manager to step in, and believe me, we live in a world where these things happen. We have had incidents where other portfolio managers got sick or passed away. Unfortunately, we've had, and as I said, this is real world stuff that we're dealing with.
Yeah.
And we then do have a very seamless handover process in the background. We do try as far as we can match the client with the right portfolio manager, because often it's personalities as well that you need to try and match. Those things are often not as easy as you think, but we do. So that part is the easy part. In terms of the I think the safety or the comfort you have to carry on with your day-to-day operations. So, I mean, the one thing you do have is in a brand like Sanlam, it is a very well-known big company with a lot of, I think stability over 100 years that it's existed, and I think there's a lot of comfort you get in dealing with a big brand that is not going to disappear tomorrow. So I think in terms of but as I said, we deal in a very niche part of the market. So we do leverage a lot off the bigger brand where we can, and we with the bigger teams that they have, whether we can pull in. But we do focus on a very niche part of the market to give clients that comfort that they're dealing with top professionals.
Thank you so much. Maybe going back to my analogy of the goose and I like that. Yeah. And so I get, and correct me. So based on what you guys have presented, I understand this is an individualized kind of portfolios that you're working with. We're talking about individuals here, and you take cognizance of some of the nuances in terms of what you indicated. If you don't, you've got an aversion towards investing in tobacco industry or whatever the case, you would look into that. So that's quite good. If I am collecting, I'm going to my goose now, if I'm collecting my eggs and I become wealthy, so I've got the wealth, but obviously what I understand from your presentation is there is a need for me to think of what happens to those eggs when I do die. Let's say I didn't kill my goose now. So if I do die, what happens? So basically, I'm talking about here generational transfer of wealth, if I can use it that way, in terms of the estate planning. How complex is that? Are there structures that someone must think about? Are they, and what role does trusts play in that regard?
So I think the first point of departure for me normally with a client is to understand the client. Is to understand the client, is to understand the family. Because sometimes the parents that sits in front of you is a representation of the whole family. Is to understand that this family, which is the parents, they've worked hard, they've worked in the practice, so they've built their wealth over a period of time, and now they started to invest their assets abroad. So typically what will happen is those investments will be in South Africa in the form of investments with Sanlam Private Wealth, portfolios, other type of assets like properties, etc. Then the client starts expanding their wealth, so they will externalize more money offshore by using their foreign allowance and start investing offshore. And then when we get back to the nitty-gritty of saying we're sitting in front of this client and what do we actually provide assistance with at the end is to say, when you've invested locally and you've invested abroad, how do we actually look at your affairs to make sure that we should transfer over to the next generation happens, number one, seamlessly, and number two is how do we make sure that we reduce and eliminate tax leakage. So a typical example, I think sometimes practically speaking, and the listeners and the viewers can perhaps relate to it, is we've got the trust. So the trust structure still has its place in South Africa. So having assets within the trust still allows the assets to be protected, number one, against creditors. Your children get married, and typically as we sit with clients will say, sure, my child is getting married. What we've rolled up is for my child and for my grandchildren. So these are the typical things. How do we protect our wealth for the children from divorce, separation? What happens, for example, grandma is going into an institution, she's got dementia, etc. Who's going to take care of her? Mom or dad is growing old, who's going to take care of them? So the trust vehicle can play a key role to actually still take care of the affairs of these people. So typically, in short, what will happen is that if your assets is in your personal capacity and you become incapacitated and you will not be able to take care of your own affairs anymore, normally your assets are frozen. And you have to go through a curator process in order to get someone to take your assets under administration. So the trust can actually step in, instead of having to go through that process with the High Court, the trust can actually continue to take care of that specific family member. And what we typically see, which I see with quite a bit of my clients that's getting older, is that the portfolio portfolio within Sanlam Private Wealth gets structured according to the needs of that particular client. What is your income needs on a monthly basis? What is the expenses for medical? And how do we as trustees sit around the table to make sure that the portfolio and the underlying assets gives effect to the need of the client? You typically find sometimes that the client has got a trust structure because everyone said go into a trust, but for that specific client, it didn't make sense to actually, he just went or she just went into it because of saying we don't want to pay any estate duty and we're running away from taxes. Now you find out some of the children is moving abroad. They're moving to Australia. They're settling there. They're moving to the UK. They're settling there. They're moving to America. They're settling there. And typically what happens is when they cease their tax residency and they decide, I've studied there, I'm working there, I'm getting married, so I'm settling there, so I'm not going to be as a tax resident anymore. I'm ceasing my tax residency. But there's all of this assets and wealth within the trust of which there are capital and income beneficiaries. The consequences of that will typically be that the conduit principle, which we all love, doesn't apply to them anymore. So you cannot distribute any of the gains, which was taxable to a maximum of 18% in the hands of the individual anymore. So you have to actually keep it back in the trust and gets taxed at trust rate of 36%. So number one, you pay double taxation on that. Number two, the child stays in Australia. You're making a capital distribution. You Australia say, what distribution is taking place here? So if this is a distribution from an offshore trust, we want to know what is being distributed to you, and we will, in addition to that, because you are now a tax resident of our country, tax you an additional 40+%. So in certain cases where clients comes to us, it is so far down the line that what you transfer from that golden egg to the next generation can end up just being between 30 and 40% of the wealth which you have created over the years. And then the client looks at us and say, what do we do now? And then sometimes, unfortunately, it is too late because there's nothing else that you can do because the child is already there. And even worse if the child is in America, because America can take the whole lot in terms of what they want. So what you transfer to your next generation has to do with how important is your planning, how much time and effort do you give to this planning. And our clients typically, which is high net worth, ultra high net worth clients, everything is designed specifically for them. So it's not a blanket approach that we apply to the client. You as a family has got specific objectives, so you get that specialized attention and a structure that works for your family. And in doing so, we say let's structure it properly to make sure that we can put the correct vehicles in place, whether it's a trust locally, whether it's a trust offshore, whether it is just leaving it in your personal name and transferring it directly to your children that's living abroad. What is the best way of doing it to make sure that they're getting maximum benefit from your estate? Once they receive it, they then have the opportunity to take it and to invest it and to continue the legacy which their parents have left them at the end. Yeah.
And I think maybe just important to add to that is to have these things reviewed, because you might have a snapshot today of your life and your objectives. A year or two down the line, things change. As you say, kids get older, they move. You need to review these things because that's where the trip up actually happens, is by doing something at one point in time and not actually thinking about it again.
So do you guys as Sanlam have some sort of a mandatory annual reminder for a portfolio review, or does that come from the client?
Look, so there's two different things. So one is the portfolio review in terms of the performance. There's continuous, and that depends on the client's requirements as well.
Okay,
some clients we have quarterly feedback, some we have once a year. Some clients, if you bug me too often, I'm actually going to fire you. So talk to me once a year, and I'll talk to you when I need you. But on this side, there's definitely encouragement. There's not a mandatory review, but there's definitely encouragement to do an annual review.
And we very much integrated, if I can put it that way, because of the service offering to our clients. So we work closely with the portfolio manager. We work closely with the wealth manager that takes care of the client's investments. So they are also, they will always pull us into the meeting. So when we sit in front of the client, in most cases, it will be the full set of team sitting in front of the client. So when these changes or proposed changes comes through, we already looked at it and we can provide the proper advice for the client. So the client typically gets the whole full suite of service. When they come to SPW and they say we want to tap into these services. And what, as Reginald also said, it's very important gets reviewed, but the structure, I normally tell my clients when we build the structure for you, that structure must be flexible enough to adjust as changes takes place in your life. So we would normally have an annual review, investment review, but we will be part of that because sometimes it is the trust that holds the assets. So we'll be part of it, and they will say, you know what, my child is looking at studying abroad. Then we say, oh, okay, so let's mark that as a red flag. And we'll tell the parents, engage with that child consistently. So when a child gives any form of inclination that they're going to settle in that country, then it gives us an opportunity to do planning and see what's the best option to make sure there's the maximum benefit for the whole family as such. So that is, yeah. So yearly reviews is important. Some clients' lives doesn't change that much. Other clients' lives does change that quite often, but it's an annual review with the client. And even so, sometimes clients just wants to double check that everything, all the T's is still crossed, all the I's are still dotted, and that is also perfectly fine. So this just to make sure your client's got the peace of mind that everything is still intact.
I'm getting too excited, but there's one piece that I realized we really didn't touch on at the beginning, nor did we cover it during your presentation. So I'm getting excited as KC, and I've got 1,000 rands in my estate, and that's what I want to come to you with. Is there a limit? What is your range of in terms of the portfolio that you're looking at? Because I think that's quite important that we clarify that.
Yeah, so we've got a minimum investment size that starts at R1 million. So in our typical clients, if I think about it, our typical clients are typically 3 to 5 million plus investable assets. So that's typically when we say we deal with high net worth individuals. That's kind of our entry level. We've got obviously clients with R1 million. We've got clients sitting north of R1 billion. So and there's very different requirements for those clients. And I think we've over the last business has been around for longer than 20 years. We've built up significant experience in dealing with those various clients, understanding their needs, setting up the right structures for them, or just managing a very simple portfolio. That is actually not that complicated for them.
And the other thing as well, Anonymous is asking here, where are your offices based? Only in the main centers? I think you did cover, but maybe
so maybe just run through. So it's a very fair question. So we've got up in Gauteng, we've got Pretoria and Joburg. We've got a Durban-based office. We've just opened an office now in Port Elizabeth or Klebega. If I say it correctly, I always got to be careful with that. Yeah, I can't do the clicking so well. So you better at Labuskaghni than I'm at Klebega. So, and then George Neisner. We've got Tiger Valley, Claremont, and Stellenbosch. If you look at, we've got our Pretoria office that they do a lot of regular trips up north into Limpopo. They go out northwest. So we service the whole country from those different offices. So we've got, even as an example, if you take the Western Cape, we've got the different, between those three offices that service the whole of the Northern Cape as well. They do Eastern Cape into the Karoo area. So because we got this large number of portfolio managers, they kind of cover different regions and depending where they work built.
So basically, if they're looking for services, they need to write to or contact one of their nearest town offices. Correct. And those people will then let them know, whatever these outreaches that they have.
100%.
Okay. Yeah. And another Anonymous is asking, what are the costs for private wealth management? Are there any performance fees?
No. So look, ours is typically just a flat, just a management fee. We typically don't have any performance fees. The only performance fees we have is where a client insists on it. We do have certain clients that said, listen, I want to test your performance, and if you perform, then I'll pay you. But again, 99% of our clients are just on a flat fee, or like just this annual management fee.
Again, Mutlajo is asking, when you create a portfolio, are you placing the assets in a single cell or combined like in other equities?
No, we have a very diverse pot of assets we build into a client's portfolio. So as an example, if a client has, let's just say, an equity portfolio with us, they say, I only want to be in shares, and it could be maybe only South African shares, or it could be a combination of South African and offshore. That portfolio will typically be constituted of around, depending on the portfolio, 40-odd shares. As an example, on the local side. The offshore side might be slightly more, around 50, 60, depending on the portfolio. So we do run slightly more concentrated portfolios because we don't just go because we got a massive pot, we want to just invest in the whole market. So we like to take more conviction in our ideas and the research we do. And that's typically what leads to that the outperformance over time, we believe. But we certainly won't just stick something in one thing and hope for the best. We build a diverse portfolio for clients to make sure, and even if we just buy equities, to give you an example, we got to be very careful how we build that portfolio, because even if you just buy shares on the JSE, there are certain things like mining, like financials, that are very cyclical. There's certain times when they do very well, and there's certain times when they do very badly. So even though we might think there's a lot of value, as an example, in resources, we can't go put 100% just in mining companies, because the volatility. So if you're taking a longer term view through the investment cycle, you got to make sure that there's different components that have different characteristics through a cycle. And what we will do, we'll sometimes tilt more in the one direction where there's value, and tilt more or less in the other direction. And that's what we try to do, is we try and navigate that with a risk mindset as well in the client's portfolio.
Yeah, I think that brings me to the question where, in terms of, we spoke about the breadth of your management team. So big enough, and you've got enough experience. But how agile are you, where, for instance, a particular shares is failing, to make a quick decision and move?
I mean, look, as I said, we manage individuals. So there's a investment team that builds the foundation in the background that says this is our best view.
Yes.
That best view gets taken by the portfolio manager with the client. They say, and that's where the customization happens, to say, this might be our best view, but we'll go underweight this, or we exclude tobacco as an example, or whatever the story might be. But if there's any decision we need to make, it can be made immediately, because we invest in liquid things. We don't invest typically, unless it's in a private equity thing, but then the client knows the risk they're going into, and that's in a liquid structure. But in most cases, it's very liquid stuff that you can sell out within a day or two.
I'm now going to allow an audience to ask a question verbally.
Perfect.
So we can hear. Let's let the audience please speak, the member speak. Let's unmute the member to speak. Are we struggling? While they're still getting the member, I'm going to hold. Okay. I can hear. Okay. While the member is being unmuted, maybe you kind of touched on it earlier on. What tax implication if the beneficiaries of your trust have moved overseas and have ceased their tax residency in South Africa? Maybe just highlight that again for me.
So it will typically depend. Number one, we understand the South African tax effect in terms of when we look at the trust, number one, and you actually have to distribute assets out of the trust that we can use the conduit principle. So the individuals who are the beneficiaries pay tax in their personal capacity on their personal income tax rate, whereas the trust typically is 36% for capital gains taxes and 45% on income. Now, when that beneficiary starts to move abroad, the first question is, where is that specific beneficiary settling? Is that beneficiary settling in Australia, in New Zealand, in the UK, in America, etc.? Because it will depend what the domestic laws of that jurisdiction is. So in the typical case, for example, in the UK, it will also be quite a high tax rate on what gets distributed to you. But with the UK, for example, there is different aspects that we have to look at in terms of is the person there on a remittance basis or not, and how does that affect that specific individual in the UK. In Australia, it's a flat out where we tax you on income, where it's capital. From South Africa, we see it as income. The same, we will look at New Zealand, we'll apply the similar principle. We look at America will just basically do the throwback rules to actually go back into the history and say, since when you have become an American resident, we go back into history, and we can actually go back into history and tax you for all of those years. And typically what people must also understand is that, especially where some clients also, because the thing is, in South Africa, we want to keep control of everything. So we want to keep control of all of our assets, the assets in the trust. So I want to remain a trustee. But what I need to realize, if you remain a trustee of a South African trust and you become a resident of a foreign jurisdiction, you actually pull the SA trust for all intents and purposes into that specific jurisdiction. And then the implication is bigger because in terms of your reporting obligations and having to give that jurisdiction access to all of the underlying assets. So you actually can negatively affect the other beneficiaries that might not be in that specific jurisdiction. So the tax implication is quite huge. So immigration has fallen away, so we don't deal with immigration anymore. So that has been stopped. So the only thing that we focus on now is the cessation of tax residency. Did you cease your tax residency in South Africa, and did you take up tax residency in another jurisdiction? And if that is the case, before you leave, if that opportunity still exists, we can do planning for you, and in some cases we have gotten it right to make sure that we can do proper planning for the client. In some cases the person has been there, and this is the funny part, where people leave South Africa 20 years, 30 years ago and say, yes, but I've fallen off the system. No one falls off the system. so because at the end, the process of actually externalizing the funds in itself, SARS will come back and say, sorry, we prove that you have ceased your tax residency, and if you can't provide that proof, there's a lot of other implications that actually goes with it. So the tax implication and consequence from an SA point of view is 36% of capital gains taxes, but the extent of the price tag for the tax bill in a foreign jurisdiction, we will have to look at on a case-by-case basis depending on which jurisdiction that person actually has settled.
The reality is very complex and short.
Yes. While you're on that, so if a South African citizen has got offshore assets, do they need a separate will for that?
Typically, it's not
offshore will.
Yeah, so it's not a legal requirement to have an offshore will to deal with your offshore assets.
Right.
But from an administrative point of view, it is important because, number one, let's assume Casey has only got a worldwide will to deal with his local and offshore assets. He's got assets in the UK, he's got assets in Italy, or assets in France as well. Now, we must take that one will, and that will is actually set up based on the laws of South Africa. So it's a valid will within South Africa, but we cannot take that will to the UK because in South Africa, what happens when you pass away, they issue the executor with the letter of executorship. That letter of executorship has got powers only within the boundaries of South Africa. You can't use your letter of executorship to go tell people in England you're going to move these assets according to the last will and testament. In order for you to do that, you need to obtain what they call a grant of probate. That grant of probate is the equivalent of our letter of executorship in South Africa. But in order to do that, the offshore probate office, so the judges sitting there ask, is this worldwide South African will a valid will? The only way we as the judges in the UK, before we can issue with this probate, actually has got the satisfaction and that it is a valid will, is that go to your high court and ask your high court to seal this will and letter of executorship for us. So that in effect means that it's going to take additional time and it's going to take additional cost just to get that will sealed. Then you have to take the wills offshore, and then only you can obtain probate. Some of the pitfalls that we look at, number one, is the terminology we use in South Africa is not necessarily the terminology they will understand in the UK. So use a fractionally bare dominion. We throw these words around in our wills thinking that it will help, but when it comes there, it comes back and says, please explain this to us. We had a typical case where clients still love to have their Afrikaans wills, but they've got offshore assets, and some of our clients were married in community of property, and we took it to Ireland because there were assets in Ireland, and they asked, what is this in community of property you're talking about? We've never heard about this concept. Please explain that to us. And on top of that, please make sure that you translate this will into English and then get it sealed by the High Court and then send it to us. In South Africa, typically in Johannesburg, we'll get a letter of executorship in 2 weeks to 3 weeks' time because they're much more efficient and effective. In the UK, just to get a grant of probate in Ireland, it can actually take you a minimum of 3 months. So having an offshore will helps to speed up the process. So it's not a legal requirement, but it does help to support the administration.
And I think maybe just something to add to why that is important, and I think for any of the members that's listening tonight, if you've ever had to deal with the death in a family and deal with the estate afterwards, as soon as you hit these massive delays, you're already dealing with an extremely uncomfortable situation. Now you add all this complexity and stuff that if you just dealt with your affairs ahead of time, you could have actually smooth out the whole process. And I think it's only once you've been through a process like that that you got a form of appreciation for the frustration that you could deal with.
Absolutely.
At the end of it. So,
but I think what I'm getting as well is once you've taken this portfolio, it's always good to keep in contact with whoever your contact is in terms of your investment, because any change in your life may affect you, and it's better to deal with it right from the beginning and walk the journey together.
Exactly.
Correct.
Yeah.
Yes.
No, lovely. I've got John. I don't know which doctor this is, but it says, John, how does an investor or how does an investor or on a monthly basis work with you? If I don't have a lump sum, how do I get started? Must I first build up a sum, then invest? So I think that talks to the minimum investable money.
So we do have funds as well that people can invest in with smaller amounts that follows the same strategy, and that in that fund we can build it up to a certain amount, and then to get to that personal portfolio level you can build it up over time.
Okay.
So there's definitely options, and I mean, again, we can put people in contact to look at those options.
Absolutely. And you're going to give the details of contact towards the end of this presentation. I think we'll take it for another 15 more minutes, and we'll see how far we go. I've got another attendee, Anonymous. When you speak of placing assets in a trust, is there donation tax payable to place funds in such a trust?
So it will depend, because normally, let's take it back. You've got the trust and you've got the individual. So I normally call that, and we normally call that the funder of the trust. So how do you fund this trust? How do you transfer assets from yourself into the trust? So there's two ways of doing it. There's by way of a loan account that you have to do it, and there's other complications for Section 7C and anti-avoidance rule sorts put into it, so I won't go into that detail. And the second option will be to actually donate the funds into the trust. And that donation, because the key is when you actually transfer the funds over to the trust, you give up ownership of that assets to the trust, and giving up of that ownership and donation of that assets, so you relinquish yourself from that assets, will then also now attract donations tax, and that will be 20% donations tax for donating the assets. But in addition to that, what happens is that there's what we call the attribution rules. So any gains and income that is attributed to the donation that the funder made or the donor made into the trust will then be deemed back to that individual. So when you do put assets in a trust, first consult. Make sure that you look at the different options, look at the different tax implications. But in principle, there are two ways. Number one, during your lifetime, by way of a loan account, and number two, by way of donation, so you pay donations tax. Yeah.
I see Dr. Andre, and I'm going to call you Dr. Andre because that's all I have. What is the recommended age these days to retire as people are living longer? How can I know that I can retire and have enough funds till the end? What do you look at?
Yeah, look, that's a very personal, no, but it's the question everyone asks, and I think we all deal with that in our personal capacity. So, firstly, there's, it's literally that there's books and books written about this, but the short answer, and I think there's a rule of thumb, that if you get to retirement age, whatever that might be, whether it's 55 or 65, what you should be thinking about, people recommend that you shouldn't be drawing more than 4% of your capital base. So if you've got 10 million rand and you're drawing 4%, you can make the sums on what that annual income is, right? That's about 400,000 per annum. So you've got to think, just to survive, can you survive on 400,000 rand per annum if you're left with 10 million rand? Or do you need to get your 10 million to 20 million to take 4 million? But again, each person is individual. They've got different income requirements. They've got different expenses some people have more expenses than others so it is a very personal story, and it depends unfortunately on your lifestyle and how you want to spend it, right? So but that's a bit of a rule of thumb. In you can draw more, but you're going to exhaust your capital potentially.
That's the reason why I'm today 98 years of age, but I'm still working.
There we go. You've looked after yourself.
So if you kind of touched on this much earlier, but I do want us to hone in a little bit, just additional information. If you're planning to move abroad or your children are living abroad, what are the things that one needs to consider in that regard with regards to tax abroad?
So number one, as we've mentioned before, consider your existing structure. Make sure that your existing structure is optimal and flexible in relation to your beneficiaries who's moving abroad. Number two, where they're moving abroad is also important. Number three, what counts for local trust in South Africa might also count for people who has offshore trust.
I see.
So the same principles will apply to say, because normally typically people will do estate planning in South Africa and mirror that estate planning with an offshore trust outside of South Africa to protect the offshore assets for beneficiaries, but the same principle will apply. Where are they moving? Which jurisdiction will they be settling in? So when you look at the pitfalls, just make sure that before they decide to go and settle there, and if they are actually now in the process of saying, Mom, Dad, I'm actually going to settle here, then don't wait. Get advice, re-look at the affairs, restructure it, because at the end, when they pass away, they normally inherit those assets, and you want to make sure they get the maximum benefit. So number one, make sure that you know what you've got, that your planning speaks to these changes taking place going forward. Rather do it earlier than doing it too late, or doing it so late that you've got a massive tax bill, because anything that you start unwinding, you've paid tax to put it in, and now you have to pay tax to take it out again. So that is it's important that you do proper planning.
But can I maybe, if you don't mind, Casey, just one thing I want to add. So what people often don't know, and not so much on the kids going offshore, but a lot of the people listening tonight will probably have shares in Apple or Microsoft or offshore maybe listed companies in the UK. And for the right reasons, they bought those, in their own personal name. And over time, the value in those shares hopefully have, grown quite nicely. And I think Stanley can maybe just comment a bit on the citus tax issues, that if you forget how much those assets are worth, at some point in the future, you're going to be taxed quite heavily potentially on those things. And it's not always just about setting up an offshore trust or offshore or local trust. There's other ways that you could just, if you just get some proper guidance and advice, where there are things like local endowments or wrappers, even offshore endowments, that if you just put it in a different structure, which is not often a massively complicated structure, but again, there's certain nuances to that. You got to be aware of, if kids go offshore, that's not the right structure again. But just to get around some of those tax complications that people aren't always aware of.
Yeah, so typically what will happen is a lot of clients will actually invest in assets, especially in the UK, and especially also in America, like your Apple shares, your Tesla shares, etc. What one needs to be aware of is that in the UK, its common law is similar to South Africa. So we've got estate duty, they've got what we call inheritance taxes. So in South Africa, we get a 4Q abatement. Each individual gets a 4Q abatement of 3.5 million rand per annum. In the UK, they've got a similar thing. They call it a no rate band of £325,000. And anything that the husband bequeathed to the wife and the wife bequeathed to the husband, in South Africa, there's rollover relief. In the UK, similar, there's also rollover relief. Things change a bit when we get to America. So you've got your Tesla shares, you've got your Apple shares. That is what they would consider also US cities assets. And I think that the listeners must also just be cautious, because sometimes what they come with is to say, but it's in Switzerland, on a platform in Switzerland, it's not in the US. But it's not about which platform you're using. It is typically, the question is it a US cities asset? That company that you invested in, is it a US corporation? You can buy it on any platform, but is it a US corporation? Yes, it is. So then you've got US cities taxes on that, and it's estate duty. So typically, in short, what will happen is, at your date of death, the first $60,000 is exempt from US estate taxes. Anything above it falls into a sliding scale up to 40% based on the market value. But also key and important, I tell the clients to note, is that when you bequeath your estate to the surviving spouse, to the husband or to the wife, if you bequeath your US cities assets to the surviving spouse, in South Africa, you get an exemption, yes. In the UK, you get an exemption, yes. But in America, you only get an exemption if the surviving spouse is a US person. If that surviving spouse is not a US person, there is no exemption. So it's important. And the other matter relating to the offshore world that you've mentioned is that in the US, if you've got US citizens assets, you need to report that estate to the US IRS within 9 months. Anything beyond that 9 months, they hit you immediately with a penalty, and they start charging you interest on that. So when you've got, so that is also where a offshore world actually plays a key role in making sure that you prevent paying those specific penalties and interest. And as Reginald mentioned, if that tax bill will be too high for your US citizens taxes, there is alternative products that can still give you the same exposure.
I see. So we're getting to the end. I would like to check if there are still people out there that want to ask a question verbally, particularly the attendee that tried earlier on. Okay. Thank you so much. Okay, so there are no other people at the moment, but if you are there, please just raise your hand and we will unmute you so you can ask the question that you want to ask. It might be a complex one, but you might be wanting to put it yourself out there. While I'm still waiting for one or two questions before we go to closure, and I'm going to ask the two of you towards the end just to say a few words before we finish. We spoke about the importance of estate planning, but I want to tip that around and say, pick up two issues. What are the risks of not planning? Just to the top of your head.
The result of planning, two off the top of my head, will number one be that you are placing those you leave behind in a not a worse position is perhaps the wrong word, but in a negative position, and you're leaving them with the mess to fix the mess. And number two is you actually build this wealth. So that means sometimes if there's no proper planning, you're giving more of this wealth away to the state than could have been used to fund your family, to look after them, and to look after generations to come. So you're actually just cutting the whole golden egg from this goose. Can only perhaps go one more generation, but you've actually planned this just not for your children, but also for your grandchildren. Yeah.
Any additional, Reginald?
No, look, I think that's certainly on the structuring side and the estate planning side. I think there is the whole build up, because I think it certainly, hopefully, the people in the audience are still majority in the building phase. Some people are probably closer to the more twilight years side of their careers. But I think you made the analogy right in the beginning of this, slowly looking after this golden egg that you're getting on a continuous basis. And I think there are some basic fundamentals when it comes to saving and investments. And it starts with making sure you're putting away enough every month. And it is, a lot of our time is actually just spent educating clients around some of the basic pitfalls of not doing the right things. And it's often the basic stuff that you need to do right on a continuous basis over time. And you often only see those results 10, 15 years or even longer down the line of that compounding. And, we've probably all heard enough about the power of compounding, but you see the power of that as you get closer to retirement if you've done the right things. And the earlier you start, the better. It's just that simple.
So back to my analogy, you've got this goose that is giving you an egg every single day. You need to look after that goose. Don't kill it. Don't rush and try and open the stomach thinking that you're going to get a lot of it. But even those eggs that you have collected and you put in a basket, remember you need someone that can help you to make sure that you are able to preserve them first, as well as to transfer them to your children, to your grandchildren, and anyone that is out there that you want to benefit. And it's a process. You need to always look at what is required, and you need to get advices in terms of that particular process. So without further ado, I don't think there is any further questions. I'm going to let the speakers to make a summary in terms of their conclusions, and then we will then get to an end. If there are any questions that maybe you think about after this presentation, you're most welcome to email to SADA on the email address that you have received, pr@sada.co.za or events@sada.co.za, and we will be able to submit those questions to the two gentlemen, and they will be able to answer you. So I'm going to hand over to the two of you. One of you can start, and you can sum up and also get to informing them where do they get the information if they want to get hold of you or get hold of your team, the other extended team, for them to be able to get assistance.
Perfect. I think firstly, Casey, thanks for a great evening. I mean, you hosted this. I mean, you definitely missed your calling in the financial world. So thanks for that. But I think from our side, just to summarize, I think, the reality is it's a complicated world out there. So I think to find a trusted partner, whether it's ourselves or you find someone that fits your needs, but I think hopefully it will be Sanlam Private Wealth, is find a trusted partner that you can form a relationship with over time, because there's enough studies, and I can bore the audience with enough quotes on studies that have been shown. We talk about those performances that you see. We can quote numbers of 15% per annum growth, whatever the story might be. Most clients don't experience that, because what happens is they start a journey, they get scared of the market, and they jump out at the worst time. They jump back in. It's this fear and greed thing that keeps most of our job is actually walking that journey and helping clients against making bad decisions in emotional times. I mean, if you just take the COVID example, the market fell. Everyone said it's the end of the world. This market's melting down. Look at they've fallen 30-40%, depending which market you looked at. I can tell you the amount of clients that phoned us and said, sell all my assets down. I'm out of this thing. Now, from there, we know that it's been one of the biggest bull markets, recoveries in the markets. And the clients that forced us to sell out have lost significant parts of their wealth as a result of that. So our journey is walking with clients, helping them make better emotional decisions, better financial decisions. And it's a partnership. I mean, it's a long-term partnership, and that's what we're here for. So,
absolutely.
Yeah, and I think to get hold of us, I'll let Sandy finish now. I mean, we've got a website that's got all our contact details on at Sanlam Private Wealth. So people can just Google that. I think it's probably the easiest thing, and you'll see if you go to the Sanlam Private Wealth website, all the different offices, the contact details are on there.
Okay, thank you.
Thank you so much for this evening and for allowing us to share a bit of our knowledge with your viewers and your listeners. Death is not always an easy thing to talk about, but it's something that is a definite. And I think that what you want to do is to make sure that you've done proper planning, that you have ensured that at the end that you've got a peace knowing that your surviving spouse will be taken care of subsequent to your date of death. Your children will be taken care of subsequent to your date of death. But also, most importantly, the wealth that you have built through your hard work and what you've inherited from your parents to structure that is applicable and speak to the times that we're currently living in, and to make sure that we actually find the right solution for you. And you find the right solution with a partner, like, for example, Sanlam Private Wealth, to make sure that we can actually continue that wealth preservation, transfer it to the next generation, and make sure that the generations coming can benefit and continue to grow what you've started. So it's a journey, it's a process, it doesn't happen overnight, but I think that it is something that will be of great benefit to any family that says that we want to preserve our wealth, but we also want to continue to grow it so that our children can continue the legacy that we have started. Yeah.
Thank you so much. Ladies and gentlemen, we have come to an end. I want to say thank you so much for all those people that have been listening. I hope today's webinar has opened your eyes, first, to the risks of not doing estate planning, particularly global estate planning, but also the need and the importance of actually doing it. If you want to, if you are thinking long term, you are thinking about your heirs, you are thinking about your beneficiaries, it is important that you do the work now so that they can benefit. Otherwise, as Stanley and as Reginald has indicated, you may be leaving them with a mess to sort. And that mess may actually be very costly, to an extent that what they finally get out of whatever you have left for them is actually pennies. Ladies and gentlemen, I'll say thank you very much. There are no further questions. We're not going to prolong this meeting. I wish you all the best and good night to everyone.